All right there, guys. I'm back. Very good evening to all. Good afternoon, late afternoon to some, and good evening to most of you. I'd like to welcome you guys. I think we can start warming up a little bit. I hope you guys can hear me loud and clear. I've checked that earlier on. We've got responses saying that it's all loud and clear, as well as being able to see my screen as well. So I'm sure that everybody could hear me, I guess, and see my screen. So we shall start. I'm just getting more confirmation about the sound system. That's brilliant. Good. Okay, so we'll get going. I've got this session recorded as well, so you can kindly send your request to FP Markets support at fpmarkets.com to get your recordings of all these webinar series. So you are at the second part of the building your resilience webinar series. So we'll talk a little bit about risk and a couple of other things. I'll go over with you on that. But just before that, I'll just, if you allow me to do so, to go over the FP Markets disclaimer. Don't worry, it's just the first two lines, as well as the couple of lines at the very bottom. So I'll just get going with that. FP Markets disclaimer here says the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. And right at the very bottom here, we've got FP Markets recommends that you seek independent advice. First, Prudential Markets Private Limited, trading as FP Markets. That's the long number across there with the Australian Financial Services license number as well, right there. So for more, you can take your time in reading them. Okay, so let's get going with today's webinar series. It's part 2, like I've mentioned. Let me just make sure I'm not going through the introduction of the company. This is the second part. So let's just. There we go. So it's part of the FP's webinar certification course series, and it is part 2 of 4 parts, but it's within the building your resilience series. Okay, so what we are going to be talking about today is capitalization versus your risk. I'll talk a little bit about risk because it does then impact your level of equity, or your level of equity does actually impact the way you manage risk, or should actually help you decide on how you're managing your risk, whether it's technically the technical side of it has got to do with risk as well as money management as well. It's intertwined, risk and money management. So we want to talk a little bit about that, but also to understand that whatever that you are actually doing in terms of either managing risk or having some sort of strategy or approach, make sure it is actually part of a trade plan, because then you would have a better idea on where these strategies apply and which comes first and second, and having a sequence of steps to analyze the market, research the market, analyze the market, and then trade the market would give you a higher chance of understanding the trend as well as the risk that is involved in the markets, in order to actually have high probability, low risk type trade ideas as well. Okay, so this is a trade plan, just a bit of an introduction on the trade plan that we've talked about. So you'll see that the R does actually come into play at the second stage of the standard operating procedure or your trade plan. So R stands for risk versus reward right there. So we've covered P stands for the psychology of the market. It has got to do with how you're researching sentiments and trend of the market to understand where should you put your focus on. But now we're going on to step 2, which is the risk element, risk and reward element of trading. Okay, so there we go. And this is how the PRIC or price trade plan looks like. Just a little bit more information right there. Just a bit of a revision that I'm doing right here. So here we have got just a little bit about the price trade plan again. P stands for your psychology of the market. R, risk versus reward. So this is where we want to pay more attention to, is step 2, where your R is where R stands for your risk versus reward. Okay, so one of the most important thing is to understand today's market risk. I mean, most of the traders may actually miss out this element where they would actually indulge more into simply technically analyzing the market. So that would then drive most of the beginners to be tempted to straight away go onto their technical charts and looking at the candlesticks and then set up and apply their indicators or even EAs. And that is the usual play of beginners and traders out there, mostly when they are actually sort of overweighted into the technicality of things. So one of the main point that I would like to make today is to understand where you stand in terms of the process that you wish to take, or the stage that you wish to take to analyze the market first, or research the market, analyze the market before you take that financial decision to click either the buy or the sell button. So what does today's market risk stand for? I mean, it does actually come into two main categories, whether it's a risk off environment or a risk on environment. Risk off, as we have mentioned in previous webinar series as well, is when traders they have switched off or toned down their risk appetite. So they're looking for more safe haven type investments or asset classes, and that's called a risk off environment. So is it a risk off environment or risk on? Risk on is where traders are having a higher risk appetite and they're going onto risky type assets. So when you look into the market and you look into more investors going into gold or the Japanese yen or the Swiss franc, that actually means that it's more of a risk-off environment, because these asset classes, gold, even the dollar to some extent, but gold, mainly gold, the Japanese yen as well as the Swiss franc are classified or categorized under safe havens as well. So when there is a risk off type environment, you'll see more buying type or interest in buying these safer asset classes. Okay, so this is one of the reasons where understanding the market sentiments, the feeling of the market, whether it's more prone to risk averse or risk on or risk off type environment, is really important for us to choose the right pairs to actually trade, or the right asset classes, the right instruments to trade. Now, this is one of the biggest step of researching and analyzing the market, is to understand what you're researching on in order to actually pick the right pair to trade for the day. So that could actually be quite an essential step that I have noticed and witnessed over 10 over years. I would say 8 to 10 over years amongst traders, especially the transition from a beginner or a rookie or a newbie to a trader who trades professionally. But I think it boils down to how the trader analyzes the market, researches the market, and then analyzes the market, and then setting up its trade to understand how to actually suss out low risk, not low probability, but low risk and high probability trade setups, as well as trade opportunities or trade ideas. Okay, so that's the part that we need to understand today's market risk, especially before we actually enter into the MT4 or MetaTrader 4 platform. Now, the MetaTrader 4 platform is usually your vehicle to the market, where you execute your trades and analyze the market. So most of the technicality comes onto the MT4 itself. But what do we actually do before we go onto the MT4, before we analyze the market from a technical perspective? We need to understand the news and current events, geopolitical events, or just big news and big hot topic that are moving the market at the moment. But it's most important to understand how could we then translate that into information that we can practically trade on or ride along that trend. So these are some of the risk themes that still stand as of today. I've made that research a couple of months back and find that it's a repetition of events that comes into these four risk themes that stretches out from the third quarter right to the fourth quarter of 2018. Okay, so we've got trade wars that are actually happening, as you know. We've got the US, we've also got US, China, various other currencies are just decreasing in value, and they're increasing their export powers, of course, their exporting powers by reducing their currency rates as well. And this does then reduce the value of the currencies, and we see a drop. I mean, from a trader's perspective, we see a lot of selling opportunities. We see that these value rates of these currencies, or price rates of these currencies, just plunges, and that's basically where trade wars and protectionism comes into play. So this is the theme that is governing at this moment of time. So just would like to remind you all as traders that we are in the midst of a trade war as well as currency wars going on, and they actually sort of intertwine between trade wars and currency wars as well. So we've got geopolitical events in the mix, and we've got some sort of political upheaval in various parts of the world, especially in the European side of it. We've got the Italian government. We've got a bit of a sort of a mix between banking and economic crisis happening there in Italy as well. So there's a couple of things, and with that, we've also got Brexit in the mix. And all I could say is it's going to be impacting loads of volatility in the market, and volatility is definitely the lifeblood of the forex market, especially, and the lifeblood of traders to actually ride along trends, prolonged trends, or even trends that are meant to just change or reverse, and then we ride along a new sort of newborn trend. So that's basically where we want to understand that all the things that are actually happening, especially risk events that I've mentioned about, is worth knowing and worth understanding. How do we actually then confirm whatever technical setup that we have with what has actually been caused in the market? Basically, catalyst. We want to look at what the catalysts are, and then we get confirmation via technicalities or technical analysis to confirm that kind of move. Okay, so we'll just move on to the second one, which is like I've mentioned earlier as well, political climate in Europe. European Union summit was in June that time, and from then on sort of rippled through a bit of a ripple effect until today. So we're still expecting more upheaval, more instability in a way in these nations that made up the euro. So we've got about 11 countries right there, and this is basically where we'll see more of that coming up. So hence the reason we would like to understand as well through your trade plan, do we pick the euro versus which other currencies, and how do we actually understand using tools that are available even in FP markets toolboxes as well, where we can actually use tools to help us understand heat maps, or I would say heat of trend, which currency would be strong. It's not really about strong or weak, it's more about which currency would be classified as being strong and stronger, or weak to weaker. Only then we would get into a trend that is that would have a prolonged lifespan. So we want to be going into a marathon of trend, not just at a trend where it might just turn around, where we would be caught up into a reversal as opposed to a continuous trend. Okay, so that's the political climate in Europe. Of course, we've got tweets here and there coming out of Trump, and that does actually impact the market a lot too. But hence the reason we are not talking about news trading as per se, whereby we just use that news and hence know the market just by listening to news and all that, and hence we click onto the button. That's not about how trading should actually be. You still would need a trade plan, hence you know how to evaluate your risk. It's all about evaluating your risk and pay more attention to the risk element of trading as opposed to just the profit or the pips level of trading. Okay, we've also got the ECB, between the ECB, European Committee Board as well as the Federal Reserve. What are their plans for either reducing or increasing rates? So are they actually reducing or increasing? Are we in a trade war? If we are, or currency war, hence the reason we see a lot of miscommunication between the ECBs or central banks and the public. We've got news communicating one thing, and then the results of it would be another thing, and vice versa. So that is adding on to more volatility in the market as well. But we want to look into that a little bit to understand the technical aspects of things. So once we've finished this side of it, I'll bring you across to the technical chart, to your MT4 itself, candlestick chart, and to look at a couple of areas that we shouldn't actually miss out when we're looking into marrying between fundamentals and technicals as well. Okay. All right. Now, oops. I think the last one there, that's your growth outlook as well. We've got European Central Banks, it has actually mentioned about growth signs. That was back in June, and now we are looking into a very different picture all of a sudden. I mean, from June, July, August, September, October, that's 4 months ago. It was all rosy and everything seemed to be, quite positive, a positive outlook in the European side, but suddenly now, I mean, 4 months now, it's got loads of a spark of instability in different countries as well. So hence the reason, I mean, from volatility to opportunity is what we would like to look into, and that's one of the best parts of trading. Forex market is it's really dynamic. We've got lots of things going on, and it could just change, but we would like to understand, how do we actually foresee that change or reversal zones, and hence the reason we're going to move on to the chart to look into these areas. So one of the areas to also look into are the economic calendar. Of course, I know traders out there, especially newbies, what they would then do is to just look at results. They're not exam results per se, so they're not really, I would say, it's an era of shadow statistics as opposed to very accurate data or readings at this moment of time. It doesn't mean that if got a positive what you call that data result, then it will just drive market up. It doesn't happen all the time. So to rely on just the results and then trading based on that, it's really risky. One of the ways I do it is just to have the economic calendar as a reminder of which data would be due for the day and would impact which type currency pair, which type currency, and that would actually be more reliable. And the other thing that you can do is to always filter out medium impact and high impact news so that we get an idea, and just to discard those low impact news. So the ones that are the red bar ones are your high impact news, and then you've got medium impact, the halfway orange bar right there. Okay, so this is where we want to filter it out and then pay attention to the flags right there that would then give us an idea which country would actually be impacted for that particular data release there. Okay, that's more a reliable thing. And then we can always go on to tools like the one that we have discussed in previous series as well, available on actionforex.com. I repeat, actionforex.com. We've got a couple of tools right there like volatility charts. We've also got heat maps in there. But with that, in combination with FP Markets tools, we call it Trader's Edge. We've also got really cool tools right there to make your decision even better, to give you a clearer vision of what to expect in terms of volatility, what to expect in terms of strength of your currencies, like the currency heat map that are available in FP Markets Trader's Edge tool. So yeah, I would encourage you guys to be curious about the tools that are available in FP Markets as well, because they would then give you an idea of current market sentiments, just to filter out the right pairs as well to trade for the day. Okay, so there we go. So we've got economic calendar right there. Now, I would like to talk a little bit about traders or risk profile before we go on to onto the charts and show you a little bit about psychological levels as well, reversals, just to safeguard your risk whilst you're trading. Okay, so what is a risk profile? A risk profile is an evaluation of an individual's willingness and ability to take risk, of course. So whether it's a risk off, risk on, do you have the appetite for more risk, medium level, or you are more conservative and looking into lower level of risk? And that's basically how you profile yourself. It should be something personal for yourself because it's your money, your equity, and you should decide on the risk level that you are comfortable in actually taking. Okay, so can also refer to the threats to which an organization is exposed, of course, and in this case, as a retail trader, it would be a threat to your business as a trader. It doesn't really mean that you cannot see it as a business if you're not a full-time trader. It doesn't mean that at all. You could be a part-time trader. You could trade just probably an hour a day or maybe an hour a week. It doesn't really matter. And but what matters though is you have a trade plan and you have a trade log. A trade log is where it would then help you understand um, what you've traded for the day, your entries, exits, your risk levels, for example, which pair of you actually traded, and just so that you get all these records of what you've traded and to give you an idea of how it has actually performed. And this would then imagine this at the end of the month would give you a sort of a record, and that trade log is really important. I've got a trade log myself, accumulated over 10 years now, and I see that it's really important for us to have trade log to also record. You could always include a comment section to understand, your reasons in entering that trade or even not entering a trade, and all these would actually be very valuable information as time goes by, alongside with your trading activities. Okay, so a risk profile is important for determining a proper investment asset allocation for a portfolio. Of course, this is on the what do you call it, investor portfolio management side of things. Organizations, of course, use a risk profile as a way to mitigate potential risk and threats, and you can do the same for yourself as an individual or retail trader. Okay. Right, now, risk profiling. Now, are you a defensive type trader? That would fall under defensive or risk tolerance type trader. Are you conservative? Are you quite reserved? Are you more focused on to reducing your risk and ignoring any, sound or hint of potential profits, for example? So it does actually depend on the level that you're actually trading, at which level or in which level have you actually been trading? Were you just beginning at the time, or your risk tolerance could actually vary as well from the number of years you've actually traded, whether you've just started or just experimenting some indicators or EAs or even strategies. So that does actually depend on how you would classify your risk level, and how you profile yourself to be. What kind of trader would you actually would like to be? Defensive risk tolerance type, or are you conservative, or even moderate risk tolerance, growth risk tolerance, where you're looking into a progressive type build up of your portfolio, for example, aggressive or even high alpha risk tolerance. So these could include money managers as well, people who manage money on behalf of traders, or even yourself, individuals or retail traders yourself. Okay, so this is where I would like to bring you across to the technical chart, just to give you a little bit of an idea of how do we apply some tools or some areas to understand the risk a little bit better. I mean, once you have got the idea of which pair you would prefer to trade for the day, it's always essential for us to then look into the trend as well. So I'll just share with you what I am actually researching on at the moment as a trader. I find that we've got from now till about 5 months down the road. We have got an interest in understanding and researching the Brexit type scenario. So that would then call upon more interest in traders as well as investors in understanding and knowing about the pound as well as pound crosses. So here I've got the GBP versus the USD, for example. I mean, we've traveled from out of the chart where we understand that, let's say, for example, we've got reports from banks and technical analysts and strategists and news media talking about Brexit and a couple of things going on. And we see that, market itself, I'm on a daily chart at the moment. And as you would notice, you've got this really strongish type bullish candle. And if you see bullish candle, first of all, like not indecisive type candle that has got a smaller body, but bigger body, stronger body, giving us hints that the market is just pumping up the rates, and you've got more bullishness in the GBP USD. So this is what we want to look at. So with that, I think news have also talked about how the Prime Minister have actually been more confident in her approach in dealing with in speaking about plans or the future of the UK with regards to the Brexit, after effects of Brexit and all that. So it has sort of cushioned down on the negativity side of things, and this is where we're looking into a bit of pump up of the GBP at this moment of time. But what I would like to help you understand as well is that when you go onto the chart, it's probably best for us to have at least 3 time frames to compare. And I would like to also share with you on the moving averages that I use. I like using the 50, the 100, as well as the 200 exponential moving average as a means of understanding the trend. And I'll also explain how do I actually do that. And it has actually been really fruitful for me in understanding the trend, give me a little bit of a clarity in knowing what the trend is, but not based on only one time frame. This is what I would like to share with you today is if you could, it's probably best for you to compare one time frame with another 2 at least. So you've got a set of 3 time frames for us to understand the trend a little bit better. And how do we do that? First of all, you need to bunk in these 3 lines. These 3 lines are your 50, your 100. You could pick your own color, for example, and you just go on to insert. For those who are new to these technical indicators right there, you can always go to insert, and then you go on to indicators right there, and then you go on to trend, and you can just click onto moving average. Now on the moving average side of it, the MA method, make sure you change that simple to exponential. I think you would be on a default setting which gives you simple moving averages, because I would like to use the exponential one. It seemed to be a little bit more sensitive as well. And the period right there, you can always start off with 50. Okay, and once you've done the 50, make sure all these 3 lines are applied to close, so that will remain the same close. You could change your color, and you click on OK. When you come back again to apply the remaining 2 lines, all you need to do is change the period from 50 to 100, and then 100, the last one, is your 200 exponential moving average. And this is not a strategy per se. This is just an indicator that we use to help us indicate or give us a bit of a hint of the trend. And how do we do that? Once you've actually applied your 3 exponential moving averages, you could start off with the 1 hour, and then you compare the 1 hour with the 4 hour and the daily chart. Okay, so another thing is we've mentioned a little bit about capitalization versus your equity level. Now, what I have actually noticed is most traders, especially the beginners or newbies, they would find it challenging to understand the connection between equity and time frame. Okay, so what that actually means is that if you are a follower of trade signal services, let's say you do rely on some sites or some services to send you signals every day, be sure that you are understanding from where these signals are generated. Are they actually generated from higher time frames, or meant to be for longer time frames or medium time frames, or are they actually, would it also fit shorter time frames? The reason I say that is because if you were to start off with lower capital, let's say your 500 mark, $200 Australian dollars, 500 Australian dollars, let's say you like to just start small, there's no harm doing that. But it is essential for you to pick your setup based on lower time frames. Okay, so it is really important for you to do that. If you are having low equity level, it's probably best for us to look into your 1 hour and below type time frame. The 4-hour daily would probably fit your 5K and above, or even more, the better, so that you would then convert your equity into safety margin, or have that as a security cushion. Because if you have a strategy that's just not proven to be high in probability, low in risk, then you've got good amount of capital, your capital becomes a risk. Okay, so this is where we need to really understand. So hence the reason I would encourage you guys to understand, even if you are getting signals every day, if you're wondering why has it not really come to expectation, it could boil down to your equity level and following the signals that are meant to be higher, for higher time frame as well. And because the whatever that's high in time frame, let's say you are having only about $200, so you're testing the Forex market out, and you've got 200 Australian dollars to actually test out trading and Forex per se, but then you are relying on setups on a daily chart or a weekly chart. That would be extremely risky, because any small, visually it may actually look really small in terms of the movement that has gone against you, but that reversal itself, that is about 100 200 pips, that looks like looks like it's just one candle, for example, would wipe out your account easily. Okay, so that is one part that you need to really understand to match your equity and your time frame. Okay, so here, for example, when we are into trend analysis, you could literally go on to any time frames, and the more the better as well, just to understand the trend. But when it comes to setups in terms of drawing the line, drawing a pattern, applying the strategy on it, you would need to be really careful in terms of your time frame versus your equity. Okay, so now we're doing the trend analysis side of it. No problems, you can actually apply a 1 hour, 4 hour and daily, for example, but I prefer to have a cluster of 3 time frames to understand the trend. Now how I do that is just very simply, let's say I've just picked out 1 hour, 4 hour and daily. I'll start off with my 1 hour chart. Now what you would like to do in relation to the 3 exponential moving average is to understand the location of the current price and current candles. You see the cluster of candles right here with the current price. Now GBP USD is trading at 1.3198, let's say. Okay, and we've got that a bit of a bearish candle happening, but where is the price, current price, as well as a cluster of candles? As you can see, they're above all 3 lines. Now when you see candles above all 3 lines, that would give you a hint of a bullish type trend. Okay, but the reason why we're comparing one time frame to the other time frame is just to have that marathon, to understand whether that story still persists. Does that story of bullishness still persist? So what we want to then do is to compare 1 hour with 4 hour and daily. What we would like to see is to look at that similar scenario of candles as well as price being above the 3 lines. If we've got a match between 1 hour, 4 hour and daily, we've got candles above all 3 lines on the 1 hour chart, on the 4 hour chart, as well as the daily, then we've got a better play of a bullish market. Okay, and hence you could pick out your strategy well to match that trend as well. So me as a patterns trader, I would be looking at bullish pattern in a bullish market, bearish pattern in a bearish market. Okay, so here we go. Let's just give you a bit of an idea. So once I have actually gone on to, looked into the 1 hour time frame, we want to go on to the 4 hour time frame. Now look at this 4 hour right here. Now with the 4 hour, just with candles alone, you could see that we still have that bullish power, that buyer's power in in the 4-hour time frame. Why? Because you see the candles and the price are above all three lines. So that's a match between the 1 hour and the 4 hour. But what about the daily chart? I hope you guys are getting that. If just stop me if you find it a little bit confusing. And here, for example, if you're looking into the daily chart, it's not the case. Why? Because you see that the candle as well as the current price, they're in between all three lines. What does in between all three lines mean? It means uncertainty. We've only got three emotions in the market. We've got greed, driven by buyers or bullishness, bulls, and then we've got fear, whereby market just plunges down. People are extracting their wealth out of an asset, and that's basically where you'll see prices just plunging. That's your bearishness taking place. That will be under all the three lines, but we're not seeing that. We see a sort of a sideways type move, whereby we see that even the three lines are moving at a 3 o'clock angle. 3 o'clock angle marks uncertainty or holding on before a breakout happens. So that means that the market's a little bit uncertain. If the market is in doubt, it's probably best for you as a trader to stay out. That's as simple as that. Because now, for example, we're looking into a bit of a movement sideways. We've not really got a clarity of trend, mainly because the candles or current price is not above the three lines or under the three lines. So hence there's no match between 1 hour, 4 hour and the daily chart. So it's probably not a good idea for us to cluster 1 hour, 4 hour and daily. So what we do is we could move one time frame up and start off with the 30 minutes chart. Let's say the 30-minute chart. Okay. So if I start off with a 30-minute chart, you can see that the candles are above all three lines. Very simple. We've got the current price as well is just above all three lines. And then as we move on to the 1 hour chart, we still have that movement of candles up. And as we move on to the 4 hour, we still see that idea as well. But the thing is that if you would like to know whether or not we've got the cluster of three time frames having a strong type trend, we need to firstly look at the candles, of course, whether it's above all three lines or under all three lines, but we need to also match the movement of candles with these three lines. Now, the three lines itself should actually follow or play along the movement of candles. What that means is that we need these three lines to move the same direction. As you can see, they're not moving upwards. These three lines are not moving upwards. Let's say I'll give you a bit of an idea. All right, now here, for example, we have got gold. Okay. Gold, for example, you see that all these three lines are pointing downwards, really nice. This would actually hint a downward type movement. Okay, but then we've got all these candles going inside the three lines. So we need two things to match up. We need the candles to be either under or above all three lines, okay, and we need all three lines to either move downwards towards earth or upwards towards the sky. All right, only then we get a match of trend as well. I hope that's clear for you guys. Any questions at all? Does that make sense? Let me just give you another example. All right, like this one here, okay, we've got the NZD, New Zealand dollar versus the JPY, Japanese yen. We've got candles, current prices. The further away it moves away and above all three lines or under all three lines, the stronger the trend is. Okay, so here, for example, we have got, firstly, candles position. Are the candles and the current price above all three lines? The answer is yes. So that does communicate a bit of an uptrend. Okay, that's your first thing. Now, are the three lines moving upwards following inflow with flowing with the candles to the same direction? And the answer is yes, it's pointing upwards as well. Okay, so then we've got candles above and three lines pointing upwards, and we've got a trend. We've got an uptrend for the 30 minutes chart. Now, does that 30-minute chart matches with the 1 hour chart? It sort of matches, but then we've got a bit of an intermingling of lines or intertwining of lines, and we would prefer lines to be separated from one another, pointing upwards or downwards. That does then communicate more clarity of trend. Okay, so I hope that makes sense. So this is basically one of the tools that you can actually use in order to understand trend or market sentiments, the 50, the 100, as well as the 200 exponential moving average. Okay. Now, the other thing I would like to continue with you is psychological numbers, but we'll take that one notch higher in the next session in part 3, where we would then be going into the technicalities of understanding reversal zones using psychological numbers as well. And I'll then introduce you to some basic setups using geometric patterns as well as price patterns. Okay, so that's basically what's upcoming in our next session, and I would encourage you to talk about your current trade if you've got any sort of difficulty in understanding things in relation to your current trade or market outlook, for example. Feel free to discuss it in your sessions. Okay, with that, I would like to open the floor, open the room to questions before we end the session for today. Any questions at all, guys? Anything that you would wish for me to go back to a little bit in order to revise and to create more clarity, of course? Any ideas at all? Anything to discuss? Any questions? Guys are very quiet. Let's come with questions, and the more the questions, the more we'll be helping each other as well. Okay, any questions at all? No? I'll just, meantime, waiting for your questions. I'm looking at the NZD, New Zealand dollar versus the JPY. We've got a bit of a pattern going on at this moment of time. I'll be giving you more of what am I doing here with the patterns and giving you a bit of a tutorial on drawing basic patterns. So this is basically where I am drawing an ABCD bullish pattern, forecasting price to reach right at the very end by having this length of the first leg equals the length of the second leg, and just by doing that you would have an ideal forecast for it to reach right there. And as you can see, it did actually reach right on the dot right there, but we would have actually traded somewhere at the center here, which is right there. So that was an area that most of the traders have actually done a buy at that area right there and to take profit there. So that was the trading area right there, just by using this very simple pattern called the geometric ABCD pattern. So I would like to share that with you, provided you ask questions today, and then we can actually take that one notch higher the next session to actually go into the technicality of geometric patterns as well as psychological levels too. Okay, so questions, guys, and I shall reward your questions with more strategy setup next week in the session. Any questions at all? No questions, so it's been clear. Any questions on your current trade? Perhaps I'll ask another question. Which pair would you like us to look into just before we go? Any pair that you would like to look into? Perhaps a pair, a currency pair, or an instrument that you're looking at this moment of time, and I'll share my outlook of it before we leave this session today. All right, I've got some response. That's good. Okay. AUD USD, Bob, that's brilliant. Okay, good. Let's look into AUD USD. Let's look at what's going on with AUD USD. We have traded quite a bit. I have personally traded AUD USD quite a bit right there. Let me just get that across. AUD USD right there, clean chart. Okay, and let's look into what we have. Let's revise a little bit in terms of what I've shared in terms of trend analysis. So here, for example, we're looking at AUD USD on a 1 hour chart trading at 0.7122 or 23. The first thing I would say, I'll cover this in our next chapter, next session, sorry, next week, is about psychological numbers. So what I will do first is just to give you a bit of an idea of where we are in terms of psychological level. Now, I use psychological levels based on the last two digits of the price, and I'll just mark these psychological levels and tell you about what it is and how to apply them in your next session. Okay, so here, for example, I'm just going to mark two prices of the AUD USD. One is at 7120. All right, I'll explain why in our next session, so do join me in the next session. 7120 as well as 7150. All right, so these are psychological levels, and I just would like to point that out just at a glance for AUD USD at this moment of time. The current price at this moment of time is sandwiched in between the psychological levels of 0.7150 as well as the 7120 area. So at this moment of time, because it's sandwiched in between these levels, me, for example, I personally wouldn't look into trading as yet. I would prefer to wait for a breakout. Yes, we can, Michael, no problem. So look into gold as well. Edward's question is there any significance for exponentialized crossing? Yes, that's a good question, but that would come into a strategy, I would think. You know, the way I actually trade, I'm very much a fan of patterns, so I trade with patterns, and I use the moving averages solely to determine the trend, so I don't actually follow any crossings of any sort. But I know that you know, a lot of traders do actually use crossing as entry points. The thing that you can actually do is to use crossing as a sign of increasing strength of a trend that you can actually use. But how I do it is I prefer to look into a very nice flow of the three lines not touching one another. So a clearer line separated from one another, the higher the separation, the stronger the probability of the trend is. So that's basically how I would angle that analysis using exponential moving averages. Okay, hope that's clear. So here, for example, before we look into gold, AUD USD, for example, we've got that range at this moment of time. So if at all I'm looking into a selling type position or order, I would prefer to wait till candles as well as price to go under all three lines. So this is still time for us to wait, in my opinion, for a sell. So at this moment of time, not yet, but in terms of a buy, I would prefer for prices to go a little bit higher, meaning to actually exit or break out from the 7150. So my ideal buying price would only be at 7160 and above, because then I would give it a bit of a, you know, my confidence level would actually go up a little bit more, knowing that there are more participants in the bulls once it has actually gone above the psychological level of 0.7150. Okay, so that's basically it. Now here the other thing as well is, if at all it favors an upward type movement, we've got a bit of a pattern right here. We've got an A from here to here. Okay, and if I just double click that and bring that right across there, we'll talk about the mechanics and how you draw and why did I draw from that point to that point in our next session, of course. Okay, so I'm using quadrilaterals. It's very simple. It's a manual as well, whereby we draw an AB's length equals CD's length, and we just complete that B to C leg right there. And what this means is there may be an opportunity to forecast prices of price of AUD USD to reach that level there at 7159 area. But I would exit at 7140 because it's probably best for us to exit before the 7150 psychological level. The reason is psychological levels like 50s or 20s or 00 or even 80s, they usually mark reversal zones. So prices usually a trend reverses, you know, within 10 pips or so, 5-10 pips or so within these psychological levels. Okay, so as an area that I would take the entry point, basically it's usually the intersection between the AD line and the B to C line. So whatever you see in the middle here, I call it the centroid. That's basically where you could see potential buying area above the 71.20 area. 71.30 would be a nice buying area to actually take profit at the 71.40 area. But this is the 1 hour chart, so you've got a that gap is not worth much in terms of pips, but for those who are trading, you know, a little bit 10-20 pips kind of possibility, yes, it is possible there. Once price does actually trigger the 7130 area, then you can look into about 20 pips or so, or 10 pips or so, but exiting before 7150 at 7140. Okay, so that's just a bit of an idea there, but we'll look into it much more as we go along next week to dig deep into the strategy a little bit more and have you understand what psychological levels are to help you understand, I would say, probable, higher probability entries and exits. Okay, better and more proper way of entering and exiting the market. Okay, let's see, no sound. I'm back. Sorry about that. I'm not sure what I did. Okay, so we'll go back to Edward's request on gold. Let's just look into gold. Um, all right, I've got something to share here on the daily chart for gold, and I've just marked several blue zones. The blue zones are non-tradable or reversal zones, so I would be trading only in between these blue zones, which are the black zone area. Or the Black Sea area, I call it, and now it's triggered my entry point at 1217 or 1218 area, and I've exited at a 131233 area right there as well. So that was quite nice, and I'm just waiting at this moment of time for gold. If at all it's actually giving us hints that it wants to be bullish, for example, then I would prefer for it to show me its bullishness by piercing through that blue zone between 1236 to 1241, and once it does, then it's got more confidence to go up to that black area right there. But we've got a significant resistant area as well between 1257 and 1266 as well right there. Okay, so this is for gold on the daily chart. Hope that's clear for you guys. Yeah, that's basically it. I do share my my analysis quite a bit, and it's working in collaboration with fpmarkets.com. So I do share it in a website called fxgeometry.com, and we're working in collaboration with FP Markets to provide mentorship education to traders, but practical and hopefully workable ones for traders out there. Okay. With that, guys, I think that's all I have for you guys today. And I would like to say a big thank you for spending your time with me. And I certainly hope you join me again next week. And we'll dig into psychological numbers, more practical type strategy and setups as well, using geometric patterns. And I would like to show you how it works on a live market. Okay, hope you enjoyed that for today. And I would love to see you guys again next week. Okay. And with that, once again, thank you very much to all and have a good night and happy pipping. Take care, guys. Bye-bye.